We'll start, as always, with a review. Of material we covered last class. So we continued on the path of discovering, discussing, understanding, and internalizing what income is, right? And we talked about the fact that it's always a function of what perspective you're coming from, what goals you're trying to achieve. And 2 classes ago, we discussed the notions of income from economic perspective, from accounting perspective, from tax perspective. We reviewed, discussed, and implemented and practiced on a difference between the two. And then we moved towards accounting methods. And we observed that, as true in the accounting world, in tax world, we also have to follow some type of format in terms of recognizing income for tax purposes, understanding and drawing some borderlines as to when, for reporting requirements, right? Because we got to report to the government what we made, how much we made, and when we made, right? And at times how. So, and that's where our good old friends came into play, and that's cash and accrual method, right? So under cash method that we started, the situation is always much easier. And when we talk about cash, the key one word, operative word was what? Received. Excellent. So income is recognized. And remember, the recognition component for tax purposes is very important, which is transaction with third party, as a result of which there is substantial change in property rights, because that's really, from practical perspective, what we as policy decision makers determine to be the most practical way to collect, the most reliable way, the most efficient way and effective way, practically speaking, to collect tax revenue. So we're waiting till you deal with somebody else, arm's length, hopefully, and we'll address and discuss situations when that arm's length element is no longer present and we cannot trust you no more. And that's when you're dealing with related parties, and we're going to have a separate set of rules, which we'll study soon. But for now, continuing with this, we said for cash method, recognition takes place when income is received. And again, please note that when we talk about received income, it doesn't have to be cash, right? We discussed this also. It could be fair market value of property, fair market value of services, or if you owe somebody money and they cancel your debt, you no longer owe money. Because remember, when you borrow money from somebody, is that income? No, we said it's one of the exclusions. What if they later say, okay, you don't have to pay us anymore? No more excuse, right? So that's when we're going to recognize income. So it doesn't have to be cash. It could be many, many different forms and formats, which is really wonderful. And therefore, we'll tax you when you get the money. Of course, anytime we have such hard set rule, when you get it, when you receive it, gets complicated, right? Because some people are going to, what we call, turn their backs on the money, right? Constructively will be deemed receiving the money, even though they didn't actually receive it, because otherwise, we said, people will be running after each other, trying to give money, trying not to take money. That would be nuts world, and our world is nuts enough already, right? So we said we have an exception, therefore, to address this concern to the general rule that income will be recognized when received under constructive receipt doctrine, right? And the constructive receipt doctrine, we said, and again, anytime I do a review, we'll always go faster because it's something we discussed at great length last class, but this is more of an opportunity to refresh your recollection, so we kind of move forward together. Those of you who missed the class, again, very important, make sure you get notes from somebody else, make sure you get homework assignments, take at least 2-3 contact information from 2-3 students to make sure you're in a loop with everything, because if sometimes I get a lot of emails and it may take me a long time to respond, so this way, because there's over 200 of you here. Okay, so having said that, constructive receipt, we said doctrine applies if income, money, property, assets, whatever it is made readily available and there are no substantial restrictions. 2 elements, right? Readily available and no substantial restrictions on receipt of the money. In other words, go, take it. I don't want you. Turn your back on the money. Another way to look at constructive receipt is turning your back on the money doctrine, which I like to refer to once in a while as such. So there are other exceptions, but for this basic overview introductory course, we need not worry about those at this stage of the game anyway. And then we talked about accrual method, right? Which was very interesting because when we study accrual method, we're really covering both accrual and cash, right? But the general rule, at least where we start, is income is recognized when? Earned, exactly. So once we talk about earned, not received, we got to have a definition. What does it mean for income to be earned? And we have all events test, okay? If this test is passed, you will be considered to have earned the income. And all events test simply says, number one, all events that determine taxpayers' right to receive income have taken place. Please note, we're not talking about actual receipt here. We're talking about right to receive, right? So if there was an agreement, you promised to do something, you fulfilled your side of the agreement, you have a right to expect to receive income, right? So that's the right, all events test. And the second part is, and the amount of income can be determined with reasonable certainty. In other words, not only you've earned the amount, but you know, reasonably speaking, how much you expect to receive, right? With reasonable certainty. It doesn't have to be very, very precise to the penny. Okay? So that's important. Once these two elements are satisfied, even though, once again, important to stress, pay attention, even though you did not actually receive the money, because you know, no, we're not in cash method, right? We're accrual method. If you have a right to receive income, you know approximately how much. You earn the money, accrual method, report income, pay taxes. Okay? And that's general rule we said. Now, if you did not earn the money yet, your accrual method, you simply received the money. As an example I gave you, I give dancing lessons. I didn't offer a single class yet, but somebody prepaid. What happens? The government puts you back, even though you're in accrual method, the government puts you back in cash method, essentially, saying, hey, prepayment, you received but didn't earn, pay taxes. Okay, income will be recognized when prepayment received. And there are two exceptions to this exception. And if you satisfy either one, you have a choice. You have a choice of paying taxes immediately on prepayments, or going back to general rule and waiting till you earn the money even though you received prepayment. Those two exceptions, one is sale of goods exception, if you're in the business selling goods, and if you use the same method of accounting for tax and financial reporting purposes. Even though you receive prepayment, you don't report income. You don't have to report income when you receive prepayment. You could wait till you actually earn. Okay? So that's important. And second exception deals with situation where somebody offers services. And we said, well, even though you receive prepayment for services, it's okay to recognize in the year of receipt only the amount you actually earn in year one. Not the whole prepayment, only the amount earned in year one. But, key point, what's the key point? Entire balance of the amount of prepayment, regardless when you will earn it. A year from now, 5 years from now, 100 years from now, you'll recognize it when? Next year. In other words, we're waiting to wait maximum 1 year. Okay? Meaning one tax filing year from the year received. Very, very important. Okay? I saw the hand. I'll take hands. This is a review. This is not a class. So let me do a review, and then after review, I'll gladly take questions. Okay? During the class, I always take questions, but this is just, it's not a quick review. I'm really spelling it out again, but I need to complete the review first. So continue with our review, okay, and understanding these different methods of accounting, which is very important. Then we talked about fruit in a tree doctrine, right? Because we talked about what is income, then we talked about when it's income, and third, we started talking about whose income is it, right? Anyway, and it's a very logical progression, in my mind anyway. And we said, well, generally it's whoever earns the money, right, pays taxes. Or whoever is entitled to the money, to put it differently, pays taxes. And this is where the fruit and the tree doctrine comes into play. Whoever owns the instrument, the tree, that generates fruit, income, pays taxes. Not who benefits, not who eats the fruit, whether it's forbidden or not. Okay? It's whoever is entitled to it. So, having said that, when we talk about portfolios, stocks, bonds, businesses, whoever owns it pays taxes, not whoever gets the money. But if you want to shift income to somebody else, all you need to do is just what? Uproot the tree and move it to somebody else's backyard, right? In our world, it means transfer the asset itself that generates income onto somebody else's name. Okay? Very important. And at the same time, we immediately studied the exception to this general fruit and the tree doctrine, and that came from alimony discussion, right? And that's where we got into the whole world and the whole conversation of divorces, right? So you were fully equipped to deal with them, and I hope nobody filed for divorce since. But to review that conversation, alimony is a very interesting exception to the rule, because under alimony rules, what they end up doing is they make person who benefits from the money pay taxes, not the person who earns the money, which is very interesting. It's an exception to the general rule, okay? Why do we do this? Why do we all of a sudden flip backwards? Because we want to encourage people to pay alimony by giving somebody who pays alimony a deduction. We'll tax the person who receives it, and even though the person who receives it usually in a lower tax bracket, so there is really a loss anyway to the government, but it's a smaller loss versus if the person never paid alimony at all and the government had to completely support that person, right? So policy in place, which is very interesting. And of course, you have a definition of alimony. You could not live together for more than 6 months. The agreement must not say that the payment is not alimony, right? It must be in cash. And the payments must stop after death, right? Because if the payments continue, then you're not supporting really anybody anymore. It's really settlement, property settlement. And for property settlement, we said no tax consequences. Remember? Husband, wife, we talked about family property, right? Everything 50-50, whatever you earn during your married life. Doesn't matter who earns it, on whose name it is. Okay, so your parents tell you, hey, put this on your name. Doesn't matter. It's a family property. Once there is a divorce, it has to be split 50-50. Okay? Unless we get into one of those funky common law states, which is outside the scope for now. So, very important. But when you transfer one asset to the other, we talked about there's no tax consequences to either, meaning if I give you a house that's in my name to my wife or ex-wife, I get no deduction, she doesn't pay any taxes. Just property settlement. We're just shifting money from left pocket to right pocket because there is a rule that says transfer of property pursuant to divorce as if nothing happens. But we need to know what the basis in the property is, right? So if my wife receives a house, what's my basis in the house, she'll say, because if I sell it, I need to know the basis. And that's the only thing you need to remember from tax perspective here, is that it's transfer basis, meaning whatever house one spouse had in the whatever basis one spouse had in the asset, the other spouse will have exactly the same basis. That's it. That's what transfer basis means. And then we talked about child support. And child support, we said, also no tax consequences. Meaning, whenever somebody pays child support, no deduction. Whenever somebody receives child support, they don't get taxed. Why? The thinking is that you can get divorced from your spouse, but you don't get divorced from your kids. Your kids are your kids. So just like during marriage, when you spend money on your kids, you don't get any deduction. You get married, you get no deduction either. You get other benefits, like exemption and other stuff, but not if they're your dependents, but not deduction. Okay? And then we quickly talked about some awards, work related. We said if it's under $400 tangible personal property given in the length of service or safety achievement. There is no tax. And one other item that we didn't get to talk about, but there's really nothing to talk about there, is it has to do with unemployment. And unemployment you receive, it's taxable income. That's it. Even though you're not working, but it's compensation as if you're working. The reason we kind of bring it up, because it used to be that it wasn't taxed in the past, but that changed. So that's the review, more than quick, but nevertheless, I wanted to make sure we're on the same page, make sure you guys are all exposed to it, and I'll be delighted to take questions at this point before we start the new class. Sale of goods and services, they're two separate exceptions. And what is the question? What was your question? The same way. So if you're in the sale of goods and you meet the requirements of the exception, which is report income for financial purposes the same way and for tax purposes, same year, then, as we said, if you meet either one of those requirements, you have a choice. You could either wait till you earn them, or you could report immediately when you receive income. It's whenever you want. That's it. And we discussed, why would somebody want to report earlier than they have to, income and pay taxes earlier? Well, because it may be good for tax purposes, tax planning. Maybe next year they're going to be a lower tax bracket or higher tax bracket or whatever it is. It's very individual, case specific, okay? Any other questions? Yes?
How is cash dealt with in property settlement?
One more time?
How is cash dealt with in property settlement?
Same way. Cash and property settlement dealt the same way. Cash, you give cash, no deduction. You receive cash, no taxation. If you're asking me what is the basis of cash, cash is cash. It's cash.
In the textbook, it's for under property settlement, it says everything except cash. It didn't really say what the exception was.
So for cash, you got to be careful. One exception we already discussed, and that could be treated as alimony, right? But as far as property settlement, if I have $1 million in my account and I get divorced, I give my wife $500,000. There's really no difference. There's no taxation, there's no deduction, and she gives cash. The exception they talked about for cash, meaning there is no, there's no basis of cash. It's basically its value. So because there is no, cash never has basis. Or to put it differently, its base is always the face amount of cash. You're sure? Any other questions? To fruit in the tree doctrine, meaning alimony is an exception to the general rule that says whoever earns the money pays taxes, not who benefits from the money. In alimony, the person who benefits from the money pays taxes, not the person who earns the money. We accomplish it by giving deduction to the person who earns the money and making the person who receives the money included in their income. Okay? Did I answer your question? Any other questions? Yes?
For the divorce settlement case, when we talk about realized gains, for example, when we talk about the house, could we apply any other type of asset to that exception?
Every asset you could possibly imagine. Boat, car, I don't know, pencil, jewelry. No, could be intangible. I could transfer to if I have some trademarks on my name or copyrights, like I wrote a book, if we gets divorced, God forbid, one day, she would have a right to half of the copyright to all the books that I published to date.
Right, so at the time of divorce, it's not taxable, but whenever the gain is realized in the future.
Yeah, so after it's not even at the time of divorce. The technical term is pursuant to divorce, which means we could get divorced and then property settlement could happen later. But as long as it's pursuant to divorce, meaning connected to divorce, because of the divorce, part of divorce agreement, these rules apply. And then when the spouse sells the assets, that's when the taxation will take place. And that's why we need to know what is the basis of the asset. Because at that time, it's amount realized minus adjusted basis equals gains or loss.
Thanks.
My pleasure. Yes? We don't cover disguised compensation. I could gladly talk to you. Hidden alimony, disguised compensation, all that stuff. We'll talk about anybody who is interested. I'll gladly talk about after class. But this is not part of the scope and curriculum for this course. Yes. No, the basis is the cost that you paid for the asset, plus minus further investment into the asset. Like I bought a house, but then I spent $100,000 repairing it. My cost goes up.
So it wouldn't be like the fair market value of like the asset at the time of like, the settlement?
No, it's the cost. Basis is the cost. Adjusted basis is the cost of the asset, plus whatever additional investment, minus depreciation. If you've been writing it off, depreciation. It has nothing to do with fair market value of the asset.
Are losses from sale of the transfer during divorce deductible or not?
One more time?
If you sell a property you got from your husband, for example, like, and you lost money, can you deduct the loss or not?
So the question was, if you sell an asset which you received as part of divorce, and you sell it at a loss, can you deduct it? Is that your question?
Yeah.
Okay, very good question. Can you? So we're going to study expenses soon in details, but we already covered this. What's going to be the answer? Come on, guys. Is it yes or no? Who says yes? Raise your hand. Who says no? Raise your hand. You're both wrong. What's the right answer? It depends. Now let's explore. It depends on what? That's right. It depends on how you use this property. So remember we said if property used for personal purposes, sold at a loss, no deduction. If the property used for whatever purposes, sold at a gain, you pay taxes. If the property happened to be capital asset, right, then you got into capital gains losses conversation. That was a loaded question. Remember, whenever in doubt, the answer is what? It depends, but not on the exam. On the exam, it will always be the wrong answer. Okay? Any other questions before we move on to bigger and better things? Yes? Correct. Child support not deductible. Yes, it's one of the exclusions for the person who receives it. So there is no deduction, no inclusion. Correct. It's completely non-taxable event for either party. So if you look at the list of your exclusions, it's going to be there, child support. Yes? No, cash is treated exactly the same way as property in terms of no tax consequences if it's property settlement. Unless, what? It's alimony, right? But we have special rules for alimony. So if it's alimony, you get a deduction, and whoever receives gets inclusion, right? But you started your question as, what if it's property settlement in cash? So if it's property settlement, then no deduction, no inclusion. No changes. Yeah, it has to be at the minimum more than one, otherwise there is no ongoing support. Because if you make just one chunk payment, well, I shouldn't say it cannot be. I guess technically, it can be. You know, if you make an agreement that, look, you're going to pay me alimony for next 10 years, and this is the amount you're going to pay me. So why don't we present value it and you give me one chunk now? So technically, yes. But everybody's going to be very suspicious because it starts looking more and more like a property settlement. Okay, but technically, yes. And if you prove, and this is a scale, so instead of waiting, I'm doing it right now, then yes. Interesting question. I'd love to look more into it in terms of regulations. But of course, in 99.99999%. It's always ongoing stream. I've never seen a one chunk payment being called alimony just due to the nature of it. Also, keep in mind, practically speaking, it would never, well, I shouldn't say it would never happen, but as long as people deal at arm's length, you generally would not agree to this. Why? Why would you not agree to take next 10 years or 20 years and prepay right now? Not that you don't know how long you're going to live. You hope the ex-spouse dies tomorrow. Because remember, the payments must stop at the death, right? So now that I think about it, I'll go back to my original answer. And you can't really project alimony to 10 years because you really don't know how long the person is going to live. So I'd like to amend my answer to you to saying if it's one chunk payment, it will be treated like a property settlement. Because the person dies tomorrow, how could you make an argument that the person is going to live? So it will be property settlement.
So it's the person that receives it if they die.
Correct. Because it goes towards support, right? Correct. You could, the payor, the person who makes a payment could die, nobody cares. Seriously. Because even if you die, if you have a estate and there's money, your ex-spouse is a creditor. Unless agreement is made that, look, I'll pay you as long as I live. You know, that's private contractual agreement. That could be done too. Yeah, I had a conversation about it last night with one of the family attorneys. There was a bar association meeting in New York last night. I'm actually president of one of the bar associations. So I was running this meeting. We had a lot of politicians. We were discussing latest developments. And you know, one of the topics came up is family law because more and more people getting divorced. So, and a few members were in the process of getting divorced. So of course, that became an immediately hot issue. So it's interesting. Anyway, you guys have a lot of questions today, and I'm happy to see this. Could it be a sign that the exam is coming up soon and people are waking up a little bit? All right. No questions? No other questions? We're moving on? Yes.
So unless it explicitly states, if I'm an individual and it explicitly states, I run my life on the accrual method, I have to assume that they follow the cash.
So the government gives you a choice. Well, first of all, you don't have to make an assumption. I mean, unless you tax preparer. If you're a tax preparer, you could ask. But naturally, 99% of the people will be in cash method. But from the technical perspective, government perspective, the government gives you a choice. Do whatever you want first year. You want to be accrual? Be accrual. You know, you want to be cash? Be cash. It's like before the baby is born. You have a choice. It could be a boy or girl. Okay? But once you're born, once you choose, you have to stick to it. Unless, if you want to change it, then you need government approval. Okay? But at first, you can do whatever you want. And it's obviously easier to be on calendar basis, cash method, and all that stuff. So I guess you talked about assumptions. It's kind of safe to assume 99% of the people will be cash method. But there is no need to assume. All right. No other questions. So anyway. All right, you ready for some new material? All right, so am I. So we're moving to bigger and better things, as I promised. And today we'll talk about exclusions. Again, we're zooming in, right? So we've been painting this broad picture, this beautiful painting, and little by little we're kind of zooming in a certain part and opening it up, you know, spreading like on your iPhone, you know, and really getting to understand, to know it. And we talked about exclusions. In fact, you know, a few minutes ago, somebody asked, is gift one of the exclusions? Said yes, right? Well, so let's talk about exclusions. In fact, since one of the biggest exclusions is gift, let's talk about gifts. Guys, I want you to realize this, the significance of this, the whole concept of exclusions. The significance of it is that if you get something as a general proposition, as compensation, whatever, you pay taxes, right? If it's an exclusion, what happens? You don't pay taxes. Exclusion is not taxable. It doesn't get into your formula. Big deal. So the government has to be extremely careful in defining what qualifies to be exclusion, because otherwise there's going to be a lot of abuse, right? So, gifts. We can't just say, okay, I received it as a gift, therefore I'm not paying taxes, right? I mean, you're already sophisticated enough to know that ain't going to happen. Otherwise, everything would be a gift in our lives, right? So, we have to talk about it. What qualifies to be treated as a gift? What is a gift? Let's talk about life. What is a gift? What makes a gift a gift? Yes?
Something given out of generosity, like expectation of like service or future service or past service.
Yeah, something out of generosity. Generosity. Okay, with no expectations. Now, couldn't you argue, well, bonus that I get from my employer, isn't that an act of generosity? Could be. No, I mean, your boss doesn't have to give you a bonus. You know, maybe they could be generous. Which is an interesting proposition, yes. Yeah, it cannot be exchanged for services, but again, in employment situation. So you guys all right. Generosity cannot be in exchange of services. In fact, the government goes much further and says gift is exchange of transfer property out of generosity or even love and affection. Can you believe it? IRS talks about love and affection. Now, don't get me to define what love means. You know, people try to do it from first days of our existence, going back to Adam and Eve. Right? But that's exactly how it's defined. Now, arguably, it is possible to have it between employer and employee. What? Of course, generosity, right? I think it's possible. Certainly love and affection. I remember I finished Baruch College long time ago. And I got into, what's now Big Four. And I remember my first day in Big Four, we were sat in the big room, like the cohort that started from different colleges and schools. And partner who was in charge of personnel came out. And the first thing he said, he goes, well, of course, hello, welcome. And then he said, look around the room. You see all these pretty faces? Forget it. If you date somebody within the firm, one of you has to leave. Which is kind of interesting, right? Of course, it never stopped anybody. There were always rumors. It's like nobody talks about it, all of a sudden, two notices. One is wedding, the other one is resignation by one of the employees. And it was always like, okay, this manager takes a senior on these trips too often. All right, so we're expecting some announcement soon or whatever. So in any case, so interesting thing is that that's what gifts are, but the government made an exception or a rule that says there's a rebuttable presumption, and we study what rebuttable presumption is, but we presume, unless you prove otherwise, there cannot be transfer of property as a gift from employer to employee. So if it's pure from employer to employee, can never be treated as a gift, always compensation, unless you prove certain relationship, whatever, which is extremely difficult to do. So as a general proposition, any transfer from employee to employee will be treated as a compensation. Okay? But in general terms, if there is disinterested generosity, love and affection, it will be treated as a gift. Now, whose mind are we looking at? That's an interesting point. Person who gives or the person who receives? Oh, I got it because they're being disinterestingly generous. or they love me. No, we don't care. It's whoever gives, right? So we look at the mind of donor, the person who gives, and say, is this person, did he or she do it out of disinterested generosity, love, and affection? Not the recipient. We don't care what you think. You guys understand? Any questions? So this is our introductory topic into the world of exclusions, okay? And we'll continue with this topic. We could talk a little bit about scholarships, actually, and the general rule. When you get scholarship as a general proposition, is that taxable? You guys are students, so your intent is tainted. The answer is yes, actually. It is taxable unless. So scholarship is taxable unless it's for what? Or we could put, I mean, if you like it, we could put it differently. You will not be paying taxes on scholarship unless it's compensation for services, right? Or room and board, right? So when it comes to scholarship, tuition, fees, cost of books related to registration and other expenses is not taxable, okay? But room and board, compensation for services generally is taxable. This is general rule. There are many exceptions that fall under it, but as a general proposition, that's really the only thing that I'd like you to remember, okay? So the real topic for today, you guys ready? It's compensation for injuries and sickness. In other words, today I will teach you how to sue people. Injuries and sickness. If it's for services that you offer that normally get paid, yeah, it will be taxable. Okay? If it's to get from your dorm to college, that would be looked similar to tuition. But we'll have a separate topic on transportation expenses in general, where we'll study that as part of travel and other expenses. So, compensation for injury or sickness. Question. You're standing on the street, or you're driving a car, or you're standing in the street and you see the car being driven, and you see another. By the way, a lot of attorneys last night were complaining, especially personal injury attorneys. They're afraid they're going to lose their jobs. You know why? Anybody? What's the biggest, or one of the biggest causes of personal injury lawsuits? Car accidents. What's the latest development with cars? Cars are driving with sensors. They communicate with each other. Technically, if it's programmed properly, it will not hit somebody. Of course, if it hits somebody, it's a separate story. But technically, humans fall asleep, drink alcohol, take drugs. Machines don't do that. Also, talking on the cell phone or taking selfie while driving. Machines don't do those things. So even if there will be accidents, I believe anyway, the rate of them will dramatically drop. Okay? So you could bring good news to your uncle. Anyway, so the cars, they collide because one was on the phone, the other was taking a selfie or whatever. Okay. What is the first thing that happens? Car accident. Hospital? No, that's not the first thing. 911? No. Insurance? You check insurance? No. You guys never seen car accident or somebody hit each other on the street? What is the very first thing that happens in New York City? You get off the car and you start cursing at each other. And it becomes whoever's louder, right? I mean, that's what people presume. If I scream louder, I'll be right. You know, I remember it happened a few years ago, and the guy jumped out, and he was screaming like off top of, and I'm just standing and smiling, like, what is the purpose of it? Like, and he couldn't understand what's going on. It's the first time nobody screamed back at him. It was a very interesting experience for him. I think he was like felt liberated a little bit. And I said, "Are you done?" It was very interesting. Anyway, so first we scream, right? I mean, are you a true New Yorker or not? All right, so after we scream and we feel already tired, then we become a little bit more rational. What happens next? Then you remember something. What? Oh my God. Everything's hurting. No, actually, you don't remember that. You remember this when you come home and you talk to your uncle. He said, "Are you hurting?" "No." "Are you sure?" So, of course, you exchange insurance policies if you have enough common sense and all the other good stuff. So, ultimately, if you cannot agree with each other, and it doesn't matter whether you agree or not, there's going to be conversation about settlement, right? Whether it's in person or if you can agree, you go file a lawsuit. I don't know if you knew it or not, but 99% of all lawsuits end up in settlements. They don't even go to trial. And in fact, I would say personally, 99% or 90% of attorneys are scared to go to trial. They all do this, they talk, they do, but God forbid, you know, this is their worst nightmare. And those who are in the industry actually knows these people, so they never take them seriously. You know, and these people get half of the settlements for their clients, what other attorneys who actually regularly litigate could receive. And I see this all the time. A good friend of mine, he's been doing this for about 30 years. And you know, some attorneys or younger attorneys or whatever, very experienced attorneys, but they just don't litigate. They'll get the settlement and clients say, no, I think I deserve more. You know, and sometimes whatever, former students call or whatever. And he, just recently, a few weeks ago, you know, he sent me an email. He received double than what the other attorney was willing to settle, just because, you know, the other side, the insurance company, knew that he's a litigator. You know, they knew there wouldn't be any games there. So anyway, but most don't litigate, they settle. So what are we suing for? Let's talk about it. You guys in the mood to sue? What are we suing for? Let's start with something. Give me some. Yes. Physical injuries. You go like this. My arm. Okay? So what is the value of arm, by the way? What is the value of arm? Nobody knows? Yes. Medical expense to replace it? What is the value of the arm? Answer. It depends. Are you a violin player? Are you, I don't know, a volleyball player? Or are you just a professor who could hold tea in the left hand? It depends. It's the future value of present value of the future cash flows. It's the, you know, your lost income, how much you could make extra or lose if you don't have it. On that note, how much is the life worth? Seriously. How much is the life? I mean, forget about life. Wouldn't you agree that every single life is precious? Yes. Wouldn't you agree that every single life is irreplaceable? Absolutely. Unless you have no heart. Wouldn't you agree that it's always a tragedy when anybody or somebody dies? It depends. So, what is the value of a life? Somebody dies as a result of an accident. Let's say it's a good person. Huh? Anybody? Answer. It still depends. Some lives are actually worthless. Economically, technically speaking. You know, 99-year-old senior citizen crossing with a cane, got hit by the car. What is his life worth? Most of attorneys won't even take the case. They're like, what am I going to collect? 5,000, 10,000, 15,000, 20,000, 50,000, whatever. Versus a young person, 19 years old, worth a lot of money. That young person who went to Baruch College, do you realize your value of your life becomes more and more valuable with every minute of our conversation? I'm serious. Because the knowledge, not just the power, but enables you to generate income. The more capacity you have to generate income, the more valuable life becomes. Okay, so this is again a side conversation. So let's go back to the point. So physical injury, when you receive compensation for physical injury, is that taxable? All right, so please write down the rule. Compensation for personal physical injury, not taxable, period. That was marketing student. Study well, otherwise you'll have to transfer out to marketing major. Then you're going to be walking around hallways saying, oh. I take it back. We love marketing people.
So can you repeat it again? Compensation?
I thought about marketing people. What I said was compensation for physical injuries not taxable. Okay? All right? It's that simple. Or at least it sounds like simple. There's obviously more to it. Maybe we'll get to it. All right. What else are we suing for? Mental distress. That's right. I'm so mentally distressed. I go to sleep at night and my mother-in-law always comes in my dreams. I can't sleep anymore. I wake up in worst nightmares. Sweating bullets. Screaming. Okay? So when somebody compensates you for mental distress, emotional distress, is that taxable? Yes. Not an exclusion. Okay? Now, just so you could appreciate the world and the bigger picture, now let's put these two together. Mental distress and physical injury. One is not taxable at all. You could get $1 million, pay no taxes, you end up with $1 million in your pocket. Mental distress, you get $1 million compensation. You pay half in taxes, you end up with half. Big difference, right? So there was a case. One person had severe mental distress after serious trauma. And of course, it would have been taxable, except that attorney brought expert witnesses, neurologists, and other experts, and they showed, actually took x-ray of the brain, or the scan, or whatever you call it, and they showed physical alterations in the brain as a result of the stress. Now, guess what that means? It means the client walks out with extra $500,000. Why? Because now it's physical. It's physical injury because there's a physical alteration. Just so you could appreciate, again, a bigger picture in the world. So, yes?
What's the line between the two?
What's the line between the two?
Fundamentally, you can argue that any mental distress is physically harmful. What's the line?
No, you can't argue that. How could you argue that? Oh, you mean physically, meaning it has to be physical injury as a result of the act, not the consequence. In other words, you could be, if you're saying, I'm physically distressed, and I'm stressing, and then I have a heart attack and I die. Well, the injury itself wasn't physical. It was just distress. Versus, if your arm is broken or you have alteration in your brain, physical, that's physical, not the consequences of it. Because the emotional distress by itself is not physical.
Right, so in the case of the court case that you just mentioned, the physical harm wasn't a consequence of the actual accident, it was a consequence of the stress that came after the accident.
No. Well, I shouldn't say it. I don't remember, I don't know the details. But there was a physical alteration in the brain. When it happened, if you know, I don't know. But the court went for it. So it's a good question. We could cover this subject in the next class. when we talk about the intricacies of litigating in emotional distress cases. Usually it's part of CLE, continuing legal education. All right, any other questions? Okay, what else can we sue for? Yes? Loss of income. Oh my God, ever since that accident, I can't work no more. And you know how much I'm losing? A lot of money. You got to reimburse, compensate me for it. Question, when I receive compensation for lost wages, lost income, is that taxable? Depends. So please write down the rule. Compensation for lost wages / income is taxable. Compensation for lost wages / taxable income is taxable unless three exceptions. Numero uno, also known as number one. If that was due to physical injury, yeah, you couldn't work, but if it was because of physical injury, no compensation, no taxes, right? Not taxable. Exclusion, in other words. Okay? Number two, if compensation comes from taxpayer's own insurance policy. If compensation comes from taxpayer's own insurance policy. In other words, you buy, you know, additional supplemental insurance, some of them cover these type of situations, no taxes. Yes?
Does that include employers? Insurance paid by the employer?
And that brings us to the third exception, and that is called compensation from workers' compensation insurance, also known as workers' comp. If you get money from workers' compensation policy, that money is not taxable. Now, for those of you wondering what that is, every employer, certainly in New York State, I'm not familiar with others, that's my area of expertise, but on the legal side, but every employer is, because the labor insurance law, whatever, but every employer in New York, for example, is obligated to carry insurance in case employees get injured while performing their duties as employees. You understand? And that's what they could claim against. And it's there, and it serves two purposes, good or bad for you to decide. One purpose, if an employee gets injured, they could get money from that policy, right? That's good. But, and this is side bonus, as you always get from me, but if you get injured at work, generally you cannot sue employer. So that's generally negative. You're limited to recovery from workers' compensation insurance, which is usually limited. Now, here's a $1 million advice, my friends. Too often I see that people get injured while doing their work, and they're told, even by lawyers, oh, you were delivering pizza and you injured while delivering pizza? Well, it's workers' compensation, that's it. Nonsense. You could get workers' compensation, but there is such thing also called third-party lawsuits. Again, I'm teaching you things way outside the scope of the course, but it's very connected, and I think you should know about these things. So when you deliver pizza and if you fall because the steps are crooked in the house, you could sue the landlord also, the owner of the house. Okay? And there are a billion other examples. Billion other examples. I'll give you a very interesting story, which I love. There was a gentleman who took his son to work. He was a truck driver, and he was delivering heavy material, very heavy material in the truck. And he took his son, and they were in the road, and there was a turn, and there was a whatever, and they flipped. And it was severe injury. So they went to a few attorneys. They said, well, it's during the work, number one, so it would be workers' compensation. Number two, he wasn't supposed to, by the rules of the employer, bring his child to work, so can't sue employer, all that stuff, okay? So he got to, that's how I learned. A friend of mine called his name is Paul, I'm not going to give last name, I don't want you to think that I'm promoting him, but what he did, he went and investigated the whole location, right? And it turns out this car was being loaded by a third-party company, and he got expert witnesses that showed that when they loaded the car, that heavy material was shifted to the right, not in the middle, and that caused flip. He sued the company that loaded, and they got like multi-million-dollar verdict versus zero. Part of the reasons why I'm sharing these stories with you, not only to make course more alive and connected to the life, but a lot of you have been asking me about different careers. Some of you have been asking me about law careers, and within law, different areas. And what is it? How do you do? How do you become good? What differentiates good professional from bad? So this is in part what I'm sharing with you. I'm happy to share my knowledge, my experiences, exposure, and I know this is helpful to you because over the years, I continue getting feedback from my former students. So this is just to give you an idea in that world, you know, where creativity comes in and kind of out-of-the-box thinking and so on and so forth. All right. What else are we suing for while we're in the mood to sue? So next time you go to your lawyer, say, are you suing for this, 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 and this? Yes.
I have a question as far as the compensation. If he gets workers' comp and he sues, let's say, a third party, and he does suffer a physical injury, does he pay taxes on the
No.
So it doesn't matter. He could be
Tax-free.
200 people.
You could sue hundreds of people, 100 parties. Yeah, absolutely. And no taxes. Yeah, as long as there's physical injury. All right. So are you guys out of ideas on how we could sue people? Yes. Damage for property. My car. My favorite car. Oh my God. Look what you did to it. Okay? Now, this is interesting, actually. Let's say I bought my car for $20,000. Okay? And brand new. And I pull it out from the parking lot, and somebody just crashes into me immediately. That actually was news today also. I saw the guy who was selling cars got killed during the test drive. These poor people. But he really wanted to sell them, I guess. I don't know. Like, yeah, we could go faster. I don't know. Not funny. Anyway, so somebody crashes into you and the car is damaged. $5,000 damage. They come out and say, I'm so sorry. Obviously not a New Yorker, right? No, I shouldn't say it. New Yorkers are very nice. Otherwise, I'll sound like one of those other presidential candidates. So, I'm so sorry. Here's $5,000. You receive $5,000. Question, what are the tax consequences? Depends on what? Wait. Right now, I'm on the street. He says, I'm sorry. I say, okay, just give me $5,000. He gives me $5,000. I'm standing with $5,000, the car next to me. Tax consequences. Excellent. So it's not taxable, but we can't just ignore 5,000. Why is it not taxable? We look at it as return of capital. Which means what? For tax purposes. Excellent. Basis gets decreased by $5,000 in this car. So if before, when I just spent $20,000, my basis was 20. I just got 5,000 back, the basis became 15. It's really the same, for those of you curious. If I went to a parking lot to buy a car and they say, we don't have a car brand new, but this is damaged car, it's $15,000. I give $15,000, I get the same car in both cases. My basis in both cases is going to be 15, which just makes sense, right? So when somebody gives you money in exchange to damage to the asset, first step, we simply, no tax, we decrease the basis of the asset. No taxation. Only after, and you were correct, if you receive more than your basis, you cannot have negative basis, right? So let's say I just paid $20,000 for this car. I come out, somebody crashes into me, and I say, you know who I am? I'm going to sue you for the rest of your life unless you give me $30,000 right now. and the person gives me $30,000, what happens then? Well, first my basis goes down to 0, but that's just 20. The other 10 is going to be my taxable income because I cannot have negative basis. Okay? You guys are great. I think we could still sue for something else. You know that first moment when somebody came out of the car and they were yelling and screaming and cursing you out? That's called libel, you know? It's like damage to your reputation because your neighbors believed every single word that person said about you, even though they never met you before. So when you get compensation for that, is that taxable? Absolutely. The government says, yeah, but you got money, pay taxes. No problem. What else can we get money for? Punitive damages. You guys know what punitive damages are? It's like when somebody reimburses you, but on top of them you go like, don't you ever do this again. You know? So sometimes like, you know, big companies or oil companies, they pay like $1,000, whatever, in damage, and then $1 million in punitive damages because, you know, government wants to make sure it never happens or whatever. Or, you know, you drive 100 miles an hour on the boardwalk, you know, you kill a few people. Well, just simply compensating for the lives of two 99-year-old who couldn't run away because they had a cane that just, you know, they'll also likely to be punitive damages, okay? What else can we sue for? Yeah, discrimination, that's another, you know, you were choosing whom to hit in the car. You chose me. You were discriminating me or something like this. So yeah, that would be taxable. How about, yes, expenses, right? I incurred $50,000 in medical expenses, and now I get this, $50,000. Question, is that taxable? Depends is a $1 billion answer. Depends on what? Who said depends? Raise your hand. Yes. Excellent. This is such a tricky question. It's really a backdoor question. Generally, if you simply incurred expense and you get reimbursed, did you incur any expense at all? No, so it should not be taxation, right? And that's how people usually think about it, except if I incurred this expense last year when the accident took place, and I took a deduction on my tax return on medical expenses, and this year I get reimbursed, what does it sound like now? We studied this doctrine actually not too long ago. Tax benefit rule, remember? Tax benefit rule. I got tax benefit deduction to which in retrospect I'm not entitled to anymore. So because of it, we'll include this money into income this year. You understand? Not because it's taxable income, because I took a deduction last year. Am I entitled to that deduction? I got reimbursed completely. I just double dipped, right? That's why when you get money back, if there was a deduction, you include it. Okay? So now you know how to sue and whom to sue. Any other questions on this? So let's continue on the world of exclusions. We're doing great on time, as always. Yes. The last one, medical expenses. Any type of expense, if you get reimbursed, you're not taxed. But if you took a deduction for them, then you will include reimbursement into income because of the tax benefit rule. Okay, you took a deduction to which in retrospect you're not entitled to. All right, so one of the things that you guys will deal with in your life, or perhaps already dealt with or dealing with, is that you may be getting certain benefits from your employers, for those of you who work for somebody. And we already discussed today that any transfer of value from employer to employee has to be taxable, right? Can be, gifts. Having said that, there are situations where employers benefit employees, but not because it's necessarily good for employees, because it's necessary for employers. Like, they don't want you to leave your desk for lunch, so they'll give you food, just stay and answer phone and chew and talk at the same time, or whatever. Okay? Or we want you to live here because, I don't know, if something is leaking in tenants' apartments, we want supers to live in the building because we'll give you a free apartment. But it's really good. So it's really almost a requirement, for the employer. So this whole area of meals and lodging covers just that. Situations where normally there is a value and normally would expect taxpayers to pay taxes on it, but because there's so much benefit for the employers, we will exclude the value. Again, our real topic, exclusion. So we start with meals and lodging, which is a very important issue for many taxpayers. So the default, I just want you to understand, the default to everything, and it's very important to have this right perspective and the right approach. Whenever you receive anything from anybody, the default, it's taxable income. Unless you show an exception, right? So when it comes to meals and lodging, there's a rule, and if you satisfy a requirement, then you could exclude. But if you don't satisfy the requirements, you cannot exclude. So again, with meals and lodging, number one, there's 3 tests, and the 4th one applicable to lodging only. If you satisfy them, you could exclude. Number one, meals and lodging are, number one, must be furnished by the employer. Must be furnished by the employer. Okay? What does furnished mean? If I give you 20 bucks, go get yourself a sandwich. Did I furnish a meal? No. So I have to provide ready food. Yeah. Giving cash or reimbursing, that doesn't fly. Okay? Has to be ready food. Now, don't get into this whole conversation about certain foods because it gets tricky sometimes. Like, for example, people live in Alaska and an employer ships meat to them and potatoes and they cook it. They have kitchen. That's not ready food. They have to cook it. So that doesn't qualify. Right? What about sushi? That's tricky. Although arguably you could eat raw meat too, right? I mean, that's what steak tartare after all is. Right? I could never get it though. A friend of mine loves it. Not only he loves the steak tartare, which I lose my appetite when he eats it, but he also, last time we went, he ordered egg. Like, so, okay, may I have it with egg? I'm like, okay, normally you get, sunny side up or whatever brought to you. The way it comes with this raw egg, like, and he starts, I'm like, okay. So it could get tricky. But technically, if you have to cook, it's not ready food. It doesn't qualify. If it's ready food, whatever that is, it qualifies. Okay? Questions on that? So that's the first test. Not enough. Second, on employer's business premises. On employer's business premises. Which means what? Office, or even within the block. 2 blocks away is too far. That's clear. It's got to be around the office or close to office building. Certainly cafeteria, right, is good, or if you could, whatever. I think that's relatively straightforward for our purposes. And of course, third test is for the convenience of the employer. It's not about convenience to you, it's about convenience to the employer. Okay? Now, last task, number 4, that's applicable only to lodging. Only to lodging. And it says, lodging must be condition of employment, not an option. Lodging, where you sleep. Okay? Must be in other words, you want this job, you have to sleep here. You don't sleep here, you cannot have this job. And that's usually the case, and very few will qualify, right, for it. So supers in the building. There was a case I remember in cemetery. The guy was living in the cemetery. You know, they gave him a little house with a bed, and he was arguing, you know, because the IRS wanted to tax the value of the housing. He goes, no, it's for convenience of the employer. Okay? They were apparently getting like midnight deliveries sometimes, or whatever it is. Okay? Any questions on this? So for lodging, you got to satisfy all 4. For meals, first 3, okay? Doesn't have to be a requirement. They cannot force you to eat there, for example. Yes, since you're all the way in the back, you have to be loud. Last one is lodging, and it must be condition of employment, not your choice. You have to live on business premises or you don't get a job. So a lot of professors get perks in certain institutions, and the institution will give them free housing. Okay? If it's not a requirement, they have to pay taxes on the value of that. Yes?
Assuming that the meals don't meet these requirements, how would you value a year's worth of meals and taxes?
How do you value a year worth of meal? How do you value everything else in life? Same way. What is the market value of whatever you're eating? What are you getting? A bagel with cream cheese? How much was the average price of bagel with cream cheese? You're getting a sandwich? What's the average price? You know, it's got to be something reasonable. That's the value. Not the cost to your employer. It's the fair market value, right? What you receive. Yeah? I remember after my first year in Big Four, one friend of mine quit, and he went to this boutique firm, small firm. And I said, why would you ever do that? It's your first year, you stick around, you get CPA after 2 years, and you could get a much better job. He goes, why don't you come to me for lunch? He's sitting, turns out every person in the firm gets delivered by a secretary, breakfast, lunch, and dinner. He had me thinking for a moment. It was a very nice setup. All right, so we're continuing in our path to possible exclusions of value received from employers, even though it's employers. Okay? So next item is no additional cost services. Okay? Now this item, first of all, applies to the same line of business where employee is. Okay? And please note, it applies only to services, not goods. Okay? So no additional cost services. Another way to look at it is excess capacity situations. Meaning there is no material cost in offering the service. So, for example, somebody, I don't know, works for airline, and airline has empty seats, they'll fly you free of charge if you're an employee. Okay? They don't count the cost of extra fuel or peanuts if they still give it to you, right? That's free of charge. But if they have to bump some customer just to fly you, well, there is a cost, right? There's opportunity cost. So there is a cost. So it's no additional cost. Or if you work for a movie theater, you could sit in empty seats, watch movie, no tax. Did you ever wonder, like you go into a movie theater and you see movie employees sitting watching a movie? You know, you come up and say, do you know it could be taxable? Especially if the room is full, right? You should feel free and come up. Unless you get up right now, you're going to be paying taxes because I have nowhere to sit. Any questions on this? Yes. No additional cost services, which really applies generally to excess capacity situation. Okay? Now, it's available not only to employee, but also employee's spouse, dependent children, retired or disabled or former employees. Okay? Yes? Discounts, they give you discounts? We're going to study discounts in a few minutes, okay? Good question. Now, please note that there is anti or non-discrimination clause here. And non-discrimination clause prohibits you from discriminating in favor of highly paid employees. Is that how I sound? Okay. It prohibits you from discriminating in favor of highly paid employees. In other words, if benefit is available only to highly paid employees, guess what? You cannot exclude it. They have to report it as income, the value of it. Okay? This becomes interesting. What is highly paid? Is $1 million highly paid? Relative, right? So the answer, once again, is it depends. Usually it's top 1-2% or so of the workforce. That's highly paid. Since many of you will go into audit, I want to share with you my first audit experience. I graduated, I got a job. I was auditing one of the biggest Wall Street firms. And as an assistant my first year, I was told, okay, you're going to audit payroll. How do you audit payroll? My senior was absent-minded. He was busy interviewing for other jobs already. So I see manuals. He goes, go ask for payroll register. So I went to payroll department of the client, ask for payroll register, and randomly select 10 people, whatever, right? So there I am, first year student, or whatever, employee, just graduated, auditing, and I'm flipping through the payroll, and of course I try to use my judgment. Some people making $50,000, I see some people making $20 million. I'm like, isn't that more important to audit those people, right? So I picked 10 people, which happened to be the highest paid employees of the investment bank, which also happened to be president, vice president, chairman of the board. So I go back to the payroll department. I said, these are the names. Please give me a payroll register, their paychecks, contracts, employment agreements, everything. Thank you very much, and I left. 10 minutes later, and this was a huge client, and when it's a huge client, they give you room, you actually audit them on their premises. We actually lived there for like almost a year. This is where I would go every day to work. 10 minutes later, we have this huge room, we have our desk, and partners have 2 offices. A partner comes out, red face. Who picked president, vice president, and chairman of the board to audit? We're about to lose these clients. That was my first lesson. You audit appropriate people, appropriate way. So I immediately went back, chose different people, apologized. I had some fun my first year. I had a horrible senior. He was a really nice guy. He just didn't supervise me at all. My next assignment was to audit bond appreciation, premium appreciation schedule or whatever. And I'll never forget this gentleman. His name is Tom. I'm not going to give his last name. I went to the floor and I said, I'm supposed to audit. You know the best thing about audit, by the way? For those of you, how many of you had audit class already? Raise your hands. Okay, so most of you didn't. The beautiful thing about audit, you don't have to know anything at all when you audit somebody. You just got to be relatively bright. Because I came, I said, listen, show me what you're doing. He showed me. How do you do it? He showed me. I go back and it doesn't make sense. And then I just recalculate, you know. And that's it. That's what audit is, pretty much. You know, it's a lot of fun. I actually love the audit. I don't want to knock the audit out, you know. I mean, my passion with taxes, naturally. But I love it. I mean, I could never do accounting. What these guys do, I would commit suicide, you know, doing the same thing day in and out. But audit, different clients every day, you know. Learn new things, meet new people. It's actually fun. And as you go higher, you spend more and more time in restaurants and stuff because you just got to keep your clients entertained. And your staff does all the audit. But anyway, so I came to this guy and I said, I'm going to audit your whatever. So he showed me. So I went back. Few weeks, I was recalculating. And finally, I found he made a mistake. I got so excited. $200,000. I go back and said, Tom, I don't know, but I just did some recalculation. It seems like you made a mistake. He's like, and he gets so red because, you know, it's his job on the line. He goes, no, Steve, it's impossible. Let me just recalculate it. I said, no, it's okay. I said, just get back to me. He took a week. He comes back to me. You were right. Like, red, you know, he's like, whatever. I said, well, he goes, what's going to happen? I said, I don't know, Tom. I'm supposed to report this. You know, I'm sorry. He goes, Steve, I have 3 kids. All that stuff. I said, Tom, you know, I just tell my senior, I mean, you know, this is. So we've been going back. He goes, let me try to recalculate. Maybe this way, maybe this way, maybe there's. We spent like almost a month and a half on this, you know. After all, he said, no, you're right. There's a mistake. I go back to my senior. I said, listen, you know, I spent a month and a half auditing these things. And guess what? We have great news. And he goes, what? I said, I found $200,000 mistake. He goes, Steve, our threshold is $1 million. Anything below $1 million is immaterial. I almost gave that guy a heart attack. So I go back to Tom, and he's like, all right, now he's going to be executed. Almost packing his desk. I said, Tom, it's immaterial. What does that mean? And I have to explain, he almost killed me. He's like, you've been torturing me? We became very good friends afterwards. He always reminds at every party about this. So he said his first gray hair came about during my audit. It shouldn't happen. You know, if I had a good senior, he would teach me, explain to me. It should never happen. It just that guy was horrible. Again, nice guy. He quit like a month later because he was about to get fired. So, but I learned a lot of good lessons that way. Anyway, so that's no additional cost services, okay? And for those of you who are curious how audit is and how it's going to be, a lot of you have been asking me, here are a few examples. So if this happens to you, it means you have a bad senior. Go talk to a manager, okay? Something that I started doing right after. That's why he started looking for a new job. All right, somebody asked about discounts. You got it. It's a customer service and friendly environment. Employee discounts. You get a job at a Gap. Have you wondered why they all wear the same jeans? Because they get discounts. Anybody works at a department store here? I usually get few people. No? Not this time? You guys are shy to admit it? Okay, so you get a discount. Question, jeans normally cost $100. You get them for $90. Is it tax? Do you get a value, first of all? No, there's no depends. If something is worth $100, I know I told you, it's not always, most of the time, but not always. It's a good try. Just like with your spouse, the answer, I love you, doesn't always work. Something's worth $100 usually. And you get it for $90. You save $10. Is that value? Yes. If you get something for less than its value, the answer is yes. Is it taxable? Answer. Depends. So we have a set of rules that you need to know. So in case of discounts, with goods, the maximum allowed discount before you'll be charged to report as an income is what? Anybody remembers from reading? Answer. Gross profit. You guys remember what that is? No? You guys are accountants. Don't you know what gross profit is? There's nothing gross about it. Just so that's your sales price minus cost of goods sold equals gross profit. So the jeans that we talked about, if the regular price I told you, sales price is $100, and what's the cost of those? $5? All right, let's give them some credit. $30? So gross profit is 70. Okay? So as long as this discount is not greater than gross profit, no taxation. It's excluded. In my example, if you got it, if the discount is $10, it means you're okay, right? But am I being too loud? No, I'm okay? All right. I just get too excited at times. But if you get these jeans for, oh, I don't know, $20, what's your discount? 80, right? The excess $10 over allowed discount is going to be taxable income. Okay? Not the entire thing, not $80, only the excess. So again, my latest example, I said, if you buy these jeans for $20, sales price, or whatever, you buy it for $20, right? The discount becomes 80, right? Why is it 80? Because regular price 100, you paid 20, so discount became 80, right? What's allowed discount? 70. So what's the difference? That's going to be your tax. You guys all could follow my beautiful handwriting? Anybody not clear? Anybody wants this autographed? Any questions? Okay, so maximum allowed discount gross profit. If you get above that, the difference is tax. That's it. Okay? In case of services, you know, you work for an accounting firm that do your taxes for free. The maximum allowed discount is 20%. Okay? 20%. So if regular price of a service, I don't know, tax preparation is $100, regular sales price, and you pay $50, what is the discount? Well, 50, I don't like this 50. Let me change it. Let's make it 30. You paid 30, so we don't have two 50s here. So what is the discount? 70. What is allowed discount? 20, because it's 20% allowed. So what is the difference? 50 you will pay taxes on. Okay? So maximum allowed discount is 20%, which in this case $20. You paid 30, which means discount you got 70. The difference, the excess $50 is taxable. Questions? Yes? There is no 50% anywhere here. $50 will get taxed. It's $50. Don't think of it in any other terms. $50. How do we get $50? Your discount that you got. How do you get a discount? Regular price minus what you paid. That's your discount. And allowed discount is $20. How do you get $20? 20% of the usual sales price, which is in this case $20. $50 is your taxable income. This exclusion is also, employee discounts, is available only if there is no discrimination in benefit of highly paid employees, okay? Now, it's possible, if you think about it, for one situation, one type of benefit to fall under two exclusions. For example, service, you know, you get, let's say, free service. It could fall under no additional cost service, or it could fall under employee discounts, right? Which one is better? No additional is better because there's no limit on how much you could exclude. The whole value doesn't get taxed as long as there is no additional cost. Versus employee discounts, your maximum you're allowed to exclude is 20%. So think about it as a way to get out from Manhattan. It's an island, right? So there are a few bridges, a few tunnels. Same thing here. You could get out from paying taxes as long as you meet the requirements of one of the exceptions, and you have a choice. Sometimes more than one will be applicable. You could get out using, I don't know, Washington Bridge, Midtown Tunnel, Holland Tunnel, Queensboro Bridge, whatever. Okay? You have a choice. So you pick the better one, the one that works best for you. The last one that I'd like to cover with you today is called de minimis fringe. De minimis fringe. Not minimal fringe. De minimis fringe benefit. What is that? Usually these are the items that are very small. Okay? But it's not enough for item to be small. It's got to be so small that it's impractical to account for. What does that mean? For example, copy machine. You work for somebody and you go, you make a copy for yourself. Did you get value? Yeah. What is the value? I don't know, whatever, 5 cents, 10 cents, 3 cents, whatever the value of making copy, whatever the regular charges are. Do you have to report it? Is it small? Yes. Is it so small that it's impractical to account for? In other words, you know, government doesn't want you to spend $10 in tracking 10 cents worth of value. But if, in order to make a copy, you have to put in employee ID, or like in college here, you have to put your student ID, right, to make copy, it's trackable. So even though it's small, but it's not impractical to account for. You understand? So usually, de minimis fringe, it gets, you know, your perfect example is like water, you know, water cooler. You know, you drink water. Is there value? Yes. De minimis? Yes. Even though you could drink a lot, but who's going to track it? It's impractical to account for, right? Or if you're at work and somebody brings breakfast, like, I don't know, donuts. Is that de minimis? I think so. You know, there is no one, I don't know, you could say problem or one issue or one element in de minimis fringes. There is no definition of what accounts, what is small. What does small mean? What is the value? $5, $1, 30 cents? The government left it for you, and it says it depends on circumstances. It's facts and circumstances. But I think we could all agree, if somebody brings donuts to the office, this plate, and you just grab it, it's de minimis. I mean, what are you going to say to somebody? Hey, that's your third donuts for today. Looking good on you. You know? So it's impractical. But if somebody gives you a sandwich or a bagel, I think that's still close, right? But what about a sandwich? A 5-food sandwich, or whatever, a food sandwich. It's $5 for one food. Is that de minimis? I don't know anymore. Well, how about whole main course? You know, they order, I don't know, I remember when we were in that, whatever, client, financial institution, anytime we worked past 7, we would get free dinner. You know, and we ordered from the most expensive restaurants around. You know, you get that meal. That's obviously not de minimis. You know? But we could write it off against client's billing, so that's okay. All right? So, you know, it's a gray line. You know, obviously a donut is de minimis. You know, full course is not. What's in between, we don't know. It's facts and circumstances. That's one of the struggles a lot of accountants have when it comes to the tax world. Because you guys are used to debit, credit, net, zero at the end of the day. You know, this whole grayness is not present in the accounting world. And a lot of people struggle with that. But then after you struggle, you get to really appreciate it and love it. Because that's where the real creativity comes into play and all the other stuff. So some of you were asking me, what's really the difference between tax and accounting? Well, tax is just better. No, I'm kidding. The difference is, you know, for those of you who have creative minds, not that you don't have to be creative in accounting, but if you're creative in accounting, go to jail. Right? Because rule is a rule. I mean, this is what you do debit, this is what you do credit, right? In tax, you know, in planning, as long as you're planning in advance, the more creative you are, the more benefit you could create for the clients. You cannot be creating and reporting it. That's jail also, right? But the planning and seeing and thinking, that's huge, and that's the main difference. With tax, a lot of it is like puzzle solving. Those of you who love puzzles, a lot of you are asking me. You know, historically, once again, about, I don't know, at least based on my polls, usually 20–30% of you will apply to a master's in tax program. But those of you who like puzzles, those of you who like, and there's another issue a lot of you have been asking me. Actually, maybe it's a good time to talk about it. You know, if you work for any company, 99% of it, you know, if you're in an accounting department, it's back office. You realize it, right? It's back office. You're an expense of the company. If you do taxes, usually it's kind of a middle office, right? Because yeah, your expense, you have to do tax return, but you also, a lot of them drive, you know, what products company sells, how, and generates money on just saving taxes. So one of the main differences, first of all, whom generally are you going to pay more for? People who generate income for you or people who are pure expense? And second, if the company doesn't do well, whom are they going to fire first or lay off first? Expense, right? Not people who generate income. So, you know, that's another element. And plus, if you, for example, some of you were asking me, well, what can I do if I go, which master degree should I get? Master accounting or master in tax? It's your decision. It's whatever you like. But I used to come here to recruit, you know, and who becomes more valuable? Somebody who has undergrad, let's say accounting, and graduate, let's say accounting, right? Versus undergrad accounting, graduate, let's say tax or finance. You know, there's more you could offer potentially. Plus, if you have masters in tax, you could always start your own business. You know, it's tough to start a business just doing accounting. Nobody's going to go to you. You have to be tax expert, right? Tax preparation, bookkeeping, accounting. So that's another thing that what master's in tax degree makes you. You become a tax expert. Now, if you're a tax expert, you could also always get, you know, the accounting and other services. So these are some of the differences. But again, it's very personal decision. Okay. But another truth is, in terms of statistics, on average, tax people make more than accountants for the rest of their professional career, from beginning through the rest, precisely because of the value they create, and because of it they could not just charge more, but get paid more as a salary. Okay, at least this is the latest statistics that I've seen. But you should always double check for yourself. Now, this de minimis fringe does not care about discrimination. So you should write down, discrimination does not apply to de minimis fringe benefits. So it's okay for your highly paid employees to eat all the donuts or whatever, and nobody else. So non-discrimination clause does not apply when it comes to the de minimis fringe, or sometimes also referred to as miscellaneous fringe benefits. Okay, any questions?